Alright, let's cover CTCH, which is an internet security company. It makes antivirus and stuff like that. Okay, start by technical analysis. This is the all history chart. The company was one of those bubble days when it went to almost $70, and it is now at $190 or so. And this is the medium-term chart, which is bullish. The stock broke out of this resistance level here, the 2003 high around 1.70, and it is now at 190. So the medium-term chart shows a positive trend. And over the short term, well, this chart isn't updated. The stock is now at 190. So the trend is bullish since the price is above the 50 days and the 200 days moving averages. Volume is low on the company, on this stock. Now, fundamental analysis. You can see here this company has the nasty habit of diluting shareholders' value. Look here, there were just 15.2 million shares outstanding in 1999 and 73 million now, and this also explains that huge decline in the price, also the deterioration in fundamentals, of course. And the current market cap is $132 million. The share count grew 21.7% on average for the past 8 years, and the market cap grew 20%. This means the stock is about the same price it was, but no, the market cap declined. It didn't grow, it declined 20%. It was $807 million in 1999 and 132 million now. Okay. As for long-term debt and the current ratio, well, long-term debt is 0 and the current ratio is 3.36, with cash and marketable securities accounting for 93% of total current assets. So the balance sheet doesn't have a problem, and the company shouldn't dilute shareholders' value so much. But maybe the balance sheet is this healthy because they're getting money by selling shares to investors like you and me. As for revenues, well, this is a pretty erratic picture. You can see probably the company changed its business model. It had revenues of 18.77 million in 2000 and 7.23 million in 2006. I expect about 11 million for 2007 and 15 million for 2008, with gross margin of 88%. Revenues are growing since 2005, when they were 3.93 million, 67% a year, and the industry average is 23% growth. Gross margin is 88% for our company and just 49% for the industry average, but the price to sales ratio already reflects these differences, since considering 2007 estimate of $11 million in revenues, the stock is trading at 12 times revenues, and the industry average trades at just 2.6 times revenues. Now, moving on to earnings per share and net profit margin. Well, what earnings per share? The company lost money every year since inception, and in 2006 they had 0 earnings per share. Net profit margin was minus 2.6% in 2006, and so there's no price to earnings ratio here. As for my valuation model, well, I had to consider a 20% dilution factor going forward, since they've been diluting shareholders' value 21.7% a year. I expect revenues to grow 50% a year for the next 3 years, and even with this very optimistic final net profit margin estimate of 30%, and considering the company will trade at average at the industry average earnings per share multiple of 40, I still find the stock not attractive. it will grow just 7.5% a year, and I want at least 16%. And there are a lot of risks to these estimates, so I really don't like this stock. On a 1 to 10 scale, I give it a 5 because the model gave me 7.5% a year, and that's the average, the market average. So I also give it the average rating of 5. But I'm not interested in this stock. Good luck if you own it. Bye.